For 100 days, they had one weapon. Every time silver approached $100, the CME raised margin requirements. December 26th, margins up. December 30th, margins up again. January 13th, they changed the entire system from fixed dollar amounts to percentage-based margins, creating an automatic tightening mechanism. January 30th, margins hiked from 11 to 15%, triggering the worst single-day crash in 44 years. Silver went from $121 to $74. February 6th, margins raised again from 15 to 18%, crushing the recovery. 5 hikes. 6, if you count the methodology change. 100 days of systematic suppression. Every rally killed, every recovery strangled. The message was clear: silver will not be allowed above $100. And then, on March 5th, 2026, something extraordinary happened. The CME reversed course. For the first time since the rally began, they cut margins. Silver futures margins dropped from 18% to 14%. Gold margins dropped from 9% to 7%. Effective after the close of trading on March 6th, tomorrow. Let me tell you why this is the single most important development in the silver market since the rally began 12 months ago. And let me tell you why every major bank, every hedge fund, and every institutional trader is scrambling to reposition right now before the rest of the market figures out what just changed. Because margin cuts do not happen in isolation. The CME does not wake up one morning and decide to make leverage cheaper for fun. Margin cuts happen when the exchange calculates that the risk of keeping margins high now exceeds the risk of lowering them. When the pressure building behind the dam becomes more dangerous than what happens when you open the valve. And right now, the pressure behind the dam is unlike anything in modern silver market history. Comex registered inventory sits at 86 million ounces, a 20-year low. March deliveries have 52 million ounces standing. The physical supply chain through Dubai is still fractured. China's export controls have been in effect for 65 days. And as of this morning, the U.S. Bureau of Labor Statistics released a non-farm payrolls report that missed expectations catastrophically. Negative 92,000 jobs. The economy isn't just slowing, it's contracting, which means the Federal Reserve, already trapped between fighting inflation and servicing $38 trillion in debt, just lost its last argument for keeping rates high. Lower rates, weaker dollar, cheaper leverage, record physical demand, 20-year inventory lows, a war still raging in the Persian Gulf. And now, for the first time in 100 days, the margin weapon has been holstered. Every force that was suppressing silver just lost its most powerful tool, and every force that drives silver higher just got a tailwind. This is not a drill, this is the setup. And by the end of this video, you will understand exactly why the next 30 days could make everything that happened in January look like a rehearsal. Let's walk through the entire margin timeline, because when you see the full sequence from the first hike to today's cut, a pattern emerges. It tells you exactly what the CME is thinking and why they just blinked. The rally really kicked off in late 2025. Silver was around $30 in January of that year. By December, it had tripled. The momentum was just relentless. We had geopolitical tension, physical supply deficits, huge Chinese demand, central bank buying, and massive retail enthusiasm. By mid-December 2025, silver was approaching $84, and that's when the CME started to get nervous. December 26, 2025. Advisory number 25393. The CME raised maintenance margins on March 2026 silver contracts from $20,000 to $25,000. That's a 14% jump. The market wobbled but held its ground. Then, December 30th, just 5 days later, another hike. Silver pulled back a little but kept on climbing. January 13th, 2026. This was the big one, the one most people missed. The CME didn't just raise margins again, they changed the entire methodology. Instead of fixed dollar amounts that they had to adjust manually, they switched to percentage-based margins. This was genius, in a devious kind of way. It meant that as silver's price rose, margin requirements would automatically increase right along with it. It was a self-tightening noose. Every single dollar that silver gained made it more expensive to hold a position. January 30th. Silver hit $121.67. The CME raised the percentage margins from 11 to 15%. When you combine that with the already high base from the methodology change, it created a massive margin call cascade that crashed silver 35% in a single trading session. $74, a $47 range in one day. It was the worst day for silver since 1980, February 6th. Silver was trying to recover, heading back toward 90. The CME raised margins again, from 15 to 18%. This was the kill shot on the recovery. Silver got slammed back down to 80, and then silence. For 27 days, the CME held margins at that crushing 18% level while silver just consolidated between $78 and $96. Every single attempt to rally was met with this invisible weight of 18% margins, just compressing all the leverage out of the system. If you've been following this channel, make sure you subscribe and hit that bell. Because what I'm about to explain is why the CME just reversed course and what it tells us about what S coming next. Now, here is what you need to understand about why they finally cut. The CME's official reason is always the same: a normal review of market volatility to ensure adequate collateral coverage. Let me translate that from exchange speak into reality. When the CME raises margins, it's because they see risk building on the long side. Too many people are buying with leverage. When they cut margins, it's because they see the opposite, risk building on the short side. The shorts are in trouble. Positions are thin, liquidity is drying up, and keeping margins artificially high is starting to cause more systemic risk than lowering them. Think about it. What happens when margins are at 18% during a period of low volatility? The legitimate hedgers, the mining companies, the industrial buyers, the refiners who use futures to manage their real business, they get squeezed out. The cost to participate is just too high. So liquidity drops, spreads widen, the market becomes thin and fragile. And a thin, fragile market is vulnerable to the exact kind of violent squeeze the CME is supposed to prevent. By cutting margins from 18 to 14%, the CME is sending a clear signal. The risk on the long side has been flushed out. The speculative excess is gone. The danger now is on the other side, a market so thin that a sudden surge in buying could create a dislocation the exchange can't control. And that brings us to the second trigger that fired on the very same day, the non-farm payrolls report. Negative 92,000 jobs. Let me put that in context. The consensus estimate from Wall Street's top economists was positive 140,000. The actual number came in at negative 92,000. That is a miss of 232,000 jobs. This is not a soft landing. This is not a cooling labor market. This is a contraction. And it hit the markets like a freight train. The US dollar dropped immediately. Treasury yields plunged. The interest rate swap market, the market where the biggest money in the world prices future Fed policy, repriced dramatically. Before the NFP report, traders were pricing in only 35 basis points of rate cuts for 2026. After the report, that expectation shifted toward 100 basis points, 3 to 4 rate cuts. The market went from higher for longer to the Fed has to cut in a single data release. Now connect this to silver. Silver is a non-yielding asset. When interest rates are high, holding silver has an opportunity cost. You could earn 5% in a treasury bill instead. That opportunity cost has been one of the biggest headwinds for silver throughout 2025 and early 2026. But when rates are expected to fall, when treasuries start yielding less, that headwind becomes a tailwind. Money that was parked in short-term bonds starts looking for alternatives. And historically, the first place it goes during a rate-cutting cycle with geopolitical tension and currency debasement is precious metals. The 2019-2020 rate-cutting cycle took silver from $14 to $30, 114% gain. The 2007 to 2008 cycle took silver from 11 to 21 before the financial crisis cratered everything, after which the response, massive money printing, pushed silver from 8 to 49, 600%. Every rate-cutting cycle in the last 20 years has produced at least 100% gain in silver. And this time, silver enters the rate-cutting cycle from a position that has never existed before, a structural supply deficit in its 6th consecutive year, cumulative shortfall over 800 million ounces. COMEX vaults at 64% below 2020 levels. Chinese exports gated, Dubai logistics fractured. Industrial demand at all-time highs from solar, AI, EVs, and semiconductors, and a shooting war in the Persian Gulf that has closed both the Strait of Hormuz and the Dubai air bridge. In previous rate-cutting cycles, silver had abundant supply and minimal geopolitical disruption. This time, it has neither. The supply is the tightest in history. The disruption is the most severe in decades, and the monetary policy environment just shifted from hostile to supportive in a single day. Now layer the margin cut on top of this. Starting March 7th, it will cost 22% less to hold a long silver futures position. That means every trader who was squeezed out by the 18% margins now has room to re-enter. Every hedge fund that reduced its position because of collateral constraints can now rebuild it. Every institutional buyer that was sidelined by the cost of leverage can now participate. You are looking at 3 simultaneous catalysts firing at the same moment, the margin weapon being holstered, the rate-cutting cycle beginning, and the physical supply crisis continuing to deepen. These 3 forces have never converged at the same time in the history of the silver market. And here is the specific data point that connects all 3. When the CME cut gold margins in September 2024 from a higher percentage to a lower one, gold rallied 18% in the following 60 days. That was without a supply crisis, without a war, without a collapsing labor market. Gold rallied 18% simply because the leverage environment loosened. Silver's beta to gold is roughly 2 to 1. A comparable move would put silver from 84 to roughly 114 in 60 days. And that assumes none of the additional catalysts, the NFP, the supply deficit, the war, add any extra fuel. Now, let me show you the full picture from the institutional perspective, because this is where the trap becomes visible. For the last 100 days, the CME maintained artificially high margins that crushed the paper price. During that entire period, institutions were accumulating physical silver at the suppressed prices. JPMorgan took delivery of 99% of all January COMEX notices, 8.1 million ounces. February set an all-time delivery record. March has 52 million ounces standing. The institutions didn't sell during the margin hikes. They bought. They used the margin weapon to flush retail longs, crash the paper price, and acquire physical metal at a discount. And now that they've accumulated their positions, the margin weapon is being retired. Think about the sequence. Step 1, raise margins, crash the price. Step 2, accumulate physical metal at the crash price. Step 3, lower margins, allow the price to rise. Step 4, profit from the positions you built during the crash you caused. This isn't theory. This is the exact sequence that played out in gold in September 2024. Margins were hiked during the summer, gold corrected, margins were cut in September, and gold rallied from 2,400 to 2,800 in 60 days. The institutions that bought the dip during the high margin period captured the entire move. And in silver, the potential move is dramatically larger. Because the January crash took silver from 121 to 74, a $47 range. The recovery since then has been choppy but constructive, with silver building a base between 78 and 96, a technical pattern that analysts call a cup and handle formation, the same pattern that preceded every major silver breakout in the last 40 years. Here's the question I want this community to wrestle with, because your analysis consistently goes deeper than anything on financial television. If the CME cut margins because the risk has shifted from longs to shorts, if the exchange itself is signaling that the danger now is a squeeze, not a crash, what does that tell you about where the smart money expects silver to go? Drop your answer in the comments. Because this is not a rhetorical question. The CME does not cut margins to help retail traders. They cut margins because their risk models are telling them that the current positioning is unsustainable. And when the entity that controls the risk architecture of the world's largest precious metals exchange tells you the positioning is unsustainable, you should listen. Now, let me add the final layer. Citigroup has a $150 target for Q2 2026. Bank of America has $309. The gold-silver ratio at 61 to 1 with gold above 5,000 suggests extreme undervaluation of silver relative to gold. The cup and handle technical pattern targets 250 to 300. And the fundamental deficit, 6 consecutive years, 820 million ounces cumulative, has no historical precedent. Every signal from every direction, technical, fundamental, institutional, and now regulatory, is pointing in the same direction. And the one force that was holding the price down just stepped aside. Let me be very specific about what I think happens next, because vague optimism is worthless. You need a framework. Phase 1, March 7th through March 14th. The margin cut takes effect. Traders who were sidelined by 18% margins begin re-entering with 14% margins. Open interest increases. Volume picks up. Silver likely tests the 86 to 88 range as the first wave of new positioning comes in. This phase is gradual, not explosive. It's the market absorbing the new leverage environment. Phase 2, mid-March through end of March. The COMEX March delivery cycle reaches its climax, 52 million ounces standing against 86 million registered. And that registered number includes metal that may not be freely available. If delivery requests exceed available supply, the exchange faces a choice. Allow a delivery failure, force cash settlement, or let the price rise to attract metal into the delivery system. Each of those outcomes is bullish for silver. A delivery stress event during a period of falling margins and falling rates would be incendiary. Phase 3, April through May. The rate-cutting cycle accelerates as more economic data confirms the contraction that the NFP just revealed. The Fed, already under political pressure from the incoming Warsh chairmanship, begins easing. The dollar weakens. Capital rotates into hard assets. Silver, with the tailwind of lower margins, lower rates, persistent deficits, and institutional accumulation, enters a new markup phase. And here's the number I keep coming back to, 12 trading days. That's how long it took silver to go from 78 to 121 in January. 12 days, a 55% move. That move happened with margins at 11 to 15% and rising. What happens when margins are at 14% and falling? With a worse supply picture, with a weaker dollar, with 3 to 4 rate cuts priced in, with a war still disrupting supply chains? I don't know the exact number. Nobody does. But I know the direction. And I know that the entity whose margin hikes were the single biggest force suppressing the price just told you, in their own regulatory filing, that they no longer see the same risk on the long side. Now, let me tell you what could go wrong. Because credibility requires honesty about risk. If the war suddenly ends and the Strait of Hormuz reopens, safe haven demand drops and silver could pull back to 75. If the Fed surprises with hawkish rhetoric despite the NFP miss, the dollar could strengthen and pressure metals. If the CME reverses course and raises margins again, which they've done before, the squeeze gets delayed. These are real scenarios, and any of them could play out. But here's the structural reality that none of those scenarios can change. The supply deficit doesn't close if the war ends. Comex vaults don't refill if the Fed turns hawkish. China doesn't reverse export controls if the dollar strengthens. The 820 million ounces of cumulative shortfall don't magically reappear. The physical reality is permanent. The paper risks are temporary. Here's what's in your control. Not the CME's next move, not the Fed's decision, not the war's trajectory. What's in your control is understanding what just changed. For 100 days, the margin weapon was the single most effective tool for suppressing silver's price. As of March 7th, that weapon is being powered down. The exchange that spent 100 days crushing every rally just told you, through its own actions, that the crushing is over. I started covering this story when the first margin hike hit in December. I told you the weapon would keep firing until the ammunition ran out. The ammunition just ran out. 18 to 14. The direction has reversed. The squeeze that everyone said was impossible when margins were at 18% just became mechanically possible at 14%. Silver at $84 with Citigroup targeting 150, with Bank of America targeting 309, with COMEX at 20-year lows, with the labor market collapsing, with rate cuts coming, with the war still burning, and now with the margin weapon holstered for the first time in 100 days. You have seen the setup before. January, 78 to 121. 12 days. The only difference between then and now is that every single variable is more extreme. The deficit is deeper. The vaults are lower. The supply chains are more broken. The rates are coming down instead of staying flat. And the margins are falling instead of rising. This is not a prediction. This is the architecture. And the architecture just changed. Remember where you were when you watched this video? Because in 30 days, you're going to look back at $84 and know exactly what it was. Not a crash, not a correction, not a bear market. A loading zone. The spring is coiled. The weight has been lifted. And the only thing left is the release.